Welcome, everybody. This is Steve Gorin, and we're here for another TCLE, Leveraging to Attain Basis Step-Up and Income Tax Benefits of Losing an FLP Case. So before we get started on the substance, we have some housekeeping to do. The program is CLE certified, and CLE certificates will be sent once we verify attendance. Please do verify your attendance. During the CLE, 3 code words will appear. When the codes appear, you should write them down, as you will need to provide them in a verification form included in the login instructions sent to you. All CLE questions should go to cle-tc@thompsoncoburn.com. You must log in with the same email address you used to register for the webinar. The login there is proof of attendance and supports our awarding CLE. If you need to leave the webinar, you should log out and then log back in when you return. The webinar is 1 hour long, and also if anybody has questions afterwards, you're always welcome to contact me. An electronic survey form will be sent shortly. We would appreciate everybody taking time to fill out the form and return to us. So, on to this presentation. So we are now past the welcome into the overview. So I'm going to talk about leveraging to attain basis step-up, and then we're going to talk about some income tax considerations when you lose a family member partnership case and how that actually can benefit. But the key part we're going to talk about to begin with is basis step-up, and the code word is leverage, because we're going to be leveraging our assets to be able to try to get a basis step-up, perhaps a free basis step-up. One thing that you can do is to take your low basis assets and to borrow all of the equity out, and we're going to talk about how you can do this, even though there's some difficult loan-to-value ratios you have to worry about. How you can do that so you can have almost no equity in your assets, get a basis step up so there won't be any estate tax since you have almost no equity, and then you can do other things to try to transfer the loan proceeds outside of the estate tax system. And we're also going to talk about you can do that when you have those low basis assets in your estate, but we can also talk about what happens if you have them inside of a trust that's outside the estate tax system. So the trust is outside the estate tax system. You don't expect to get a basis step up, but you would like to have one. So how can you do that? I'm going to start kind of basic here, 2 basics for a lot of the people. I know there's a lot of you who know this stuff cold, but I want to make sure everybody's up on the same page. So I'm going to talk about some really basics here, and then we'll start getting to some of the advanced ideas. So when assets are included in a decedent's estate for estate tax purposes, they receive a new tax basis. So that can include if they're in your probate estate, if they're in a revocable trust, or if they're in a marital deduction trust for the surviving spouse. All of these can create that result. Multiple depreciation opportunities. So let's talk about different types of assets you might be using in your business. You might have real estate. You might be a real estate developer. You might be somebody who has commercial real estate that you rent out. You might have apartment buildings that you rent out. You might be a business owner and you use the assets inside your business. You might have a plant there or a distribution facility or something like that, and you use it in your business. So you get to write off. Real estate typically is over about 30 to 40 years. You can write off the value of it, so each year you can get a deduction, and that can reduce your ordinary income for income tax purposes. And this is especially powerful when you have equipment, because there's a special code provision, Code Section 179, that could let you write off up to $500,000 of equipment purchases each year. And so you can get this ordinary deduction against your income each year. that you buy the new equipment. So what will happen is you'll take all these write-offs, and just because you've taken depreciation write-offs, that doesn't mean the value has gone down. I mean, if you have real estate, a lot of times you are reducing the value, reducing your tax basis because you're taking the depreciation deductions every year, so your basis is going down every year. But the real estate might have the same value, or it might even increase in value. So real estate is a great example of this, that you can be taking deductions, getting tax benefits every year, and it reduces your basis. So even if it doesn't go up in value, it would be really nice if you could get a new basis down the road. So for example, you might have a married couple, and the first spouse buys the property and takes depreciation deductions. And then the first spouse dies and passes the property to the new spouse. Well, the new spouse will get a new tax basis. So you might have bought a building for $1 million, and you might write off that building, so now it has a zero basis. And then when the surviving spouse gets a property, they'll have a new basis in that. They might have a $1 million building value. The building might be worth $2 million. Whatever that is, they get a new basis. And then the surviving spouse gets that property, no estate tax, because of the unlimited marital deduction, and yet they get a new tax basis, and they can depreciate it all over again. This is especially powerful with equipment, because whereas with real estate, you're going to writing it off over 30 or 40 years. With equipment, you can write that off in 3 years, 5 years, really fast. So the first spouse to die can write off the property, and then the second spouse gets to write it off all over again with zero estate tax cost. Then, when the surviving spouse dies, you might or might not have estate tax, but then there's another opportunity to have the stepped-up basis and let the children depreciate the new basis. So you could depreciate the same property possibly as much as 3 times, once by the first spouse, once by the surviving spouse, and then by the children. So you can really milk some good tax benefits out of your depreciable property. So let's go on to slide 7 and talk about how we might be able to work some magic, so to speak. So normally, you can't borrow all of the equity in an asset. And because the lenders, they like to have some differential there, because there's always going to be losses on foreclosure. It's always an expensive process, and they have a lot of fees to recover from that too. So normally, you're not going to borrow 100% of the equity in your asset. If you have real estate, a lot of times it's only maybe 65 cents on the dollar. But there is a way to do it, and to work some magic here, and to extract all of the equity out of it. And I first got turned on to this process in an ACTEC meeting. John Bacher mentioned it to me, but I know there are a lot of people who have been using this, and I just haven't seen anybody really talk about it. But there's a lot of lenders who will do this, and so let's go through the process. So what you do is, for example, let's suppose you had a $10 million building. You take a $10 million loan against the building, and you put those loan proceeds into one or more accounts. And those accounts will also have a security interest against them. So the lender will have the $10 million building as collateral and the $10 million cash account as collateral, so a grand total of $20 million collateral. So you're not having 100% loan to value, you're having 50% loan to value. $10 million loan divided by $20 million collateral, it's only 50% loan to value. So this is actually a very safe loan for the lender to make because it's very well protected with twice as much collateral as the amount of the loan. Now, of course, the devil is in the details, and when you have a secured account, how are you going to transfer that secured account? So I'm going to take you through a process of how you can transfer that secured account, maintain the collateral in that account, and kind of supercharge your estate planning with it, and go through each of the elements in this loan deal. So at the top, you see the grantor. That's the person who has a property right now. And at the bottom, you can see that the grantor is giving a note, a secured note, to the lender in exchange for the loan proceeds. And so those loan proceeds are going back up in the middle to the grantor. And on the left-hand side, that's the real estate. And you can see I have these dashes down to the lender. The lender is keeping a security interest in the real estate. So far, that's very traditional. So the non-traditional part is on the upper right-hand side. The grantor is taking the loan proceeds and putting them into one or more LLCs. And what I would probably wind up doing is probably having about 4 or 5 different LLCs that are going to have these loan proceeds. And I'm going to explain to you why I might do the multiple LLCs in a moment. But before we get into the details, let's just start simple. So the loan proceeds go into one or more LLCs. Those LLCs will maintain the secured bank accounts, okay? So the security interest is in the LLC's bank accounts. And the idea here is that the grantor who owns the LLC can transfer the LLCs as part of the estate planning strategies, okay? But the security interest stays intact. So it doesn't matter who owns the LLCs, the security interest is in the bank account that the LLC holds. So when we do all these different transfers for estate planning purposes, the security interest in the bank account is not disturbed. Okay. So before we move on, let me just do a little bit more housekeeping here. You should have downloaded 2 things when you did this program. The first is these slides. The second is that there are some supporting materials to these slides. And you'll notice at the top of the slide I have a reference to Roman numeral 2, H, 10, E, Romanet 1. So what that is we have supplemental materials, and those supplemental materials are actually my newsletter. And my newsletter will link to more details on this, and it also has a link to my more detailed materials, about 1,300 pages of materials on business structuring. And so these links are to those 1,300 pages of materials, and if you just copy this 2H10E1 from it, you can go into the longer materials and find all the detailed technical support for it. And most of you who are on this call have subscribed to my newsletter, and that's how you found out about the call. But some of you did not, and I encourage people to sign up for my newsletter. it's a quarterly newsletter, and I have the latest version of this 1,300 pages of materials is disseminated quarterly along with comparisons. Okay, so back to it. So now we have the grantor, and the grantor has put these loan proceeds into one or more LLCs, and the lender has a security interest, and the security account is owned by the LLC. This is just the same slide kind of reconfigured. And we know the lender has a security interest in the building, and I'm kind of having the building kind of set off to the side now because I'm talking about what are we going to do with the loan proceeds. So the lender does have the security interest in the building. That's kind of a given. So let's look at this slide again. So slide 10, so you have the grantor at the top, you have the lender at the right-hand side. The grantor still owes the note to the lender. The lender has a security interest in these accounts owned by these LLCs. So the grantor owned 100% of these LLCs to begin with. And the other thing that we're going to do on this is we're going to interpose a guarantee fee. And here's the reason. These LLCs are going to be transferred using some various estate planning strategies, and they're going to be transferred to the grantor's kids or probably to trusts that are intended to be outside of the estate tax system. Now, if the grantor transfers these LLCs to trusts or intended to be outside the estate tax system, think about the dynamic here. The grantor is benefiting from these LLCs because these LLCs are guaranteeing the loan to the lender. So that would be bad if the grantor is benefiting from these assets that are being transferred later. Because if you benefit from assets that are being transferred later, then those assets would be brought into the grantor's estate under Code Section 2036. Any retained interest that the grantor has could be brought back into the grantor's estate. And then all the advantage of these leveraged estate planning techniques, that can go poof, up in smoke, because the Code Section 2036 inclusion can kill the deal. So what's going to happen is the grantor will pay a guarantee fee to the LLC. You know, LLC, you're doing something for me. You're guaranteeing my loan. You are taking on a risk, because if the loan defaults, then the lender will grab your security interest. If it grabs your security interest, then all you have is a suit against me. But if I've defaulted, then I'm in bad shape, so you might not be able to collect against that. So you're taking a risk in guaranteeing this loan. You deserve to be compensated. Now, what is an appropriate guarantee fee to pay? And the true answer really to me is you need to get an appraiser to tell you what the guarantee fee should be. Now, there are some people who they just do like an arbitrary 1%. They've seen that sometimes charged on lines of credit, and so they just kind of continue to do that. And I have heard tales of people who have charged a 1% guarantee fee, and the IRS has audited the transaction, and the IRS has been satisfied with that 1% guarantee fee. But I just don't know what it will be, and I would rather get an appraiser to tell me what they think the guarantee fee should be. So we want to pay a fair guarantee fee so that the grantor is fully compensating the LLC. And in fact, I'd want to err on the high side in paying the guarantee fee. We have the grantor at the top who is transferring the LLCs to one or more trusts. And you can see the lender is just kind of sitting there happy as can be. The lender has a security interest in the LLCs, still has an ongoing interest in the real estate that's off to the side, so the lender is very well secured. And so now the grantor might transfer the LLCs to one or more trusts. And I'm going to give you one example of one type of trust. I mean, there's actually a couple different ways you can do it. You could just do your kind of standard sale to an irrevocable grantor trust. The problem with the sale to the irrevocable grantor trust, if you're just doing marketable securities, is you really don't know whether the securities are going to go up or down compared to the value when you put them in. And so you could be doing a sale for a note, and then they go down, and then the transaction doesn't really work, and normally you've put seed money into the trust, and so you've blown your seed money. So a sale, if you have marketable securities you're going to sell to an irrevocable grantor trust, that's kind of risky to me from an exemption viewpoint. And is your portfolio going to outperform? Again, we don't know whether it will. It might very well, but a market return might give you just a small kind of delta, a small difference between the interest rate that you're paying back on that loan. Another technique, I first heard this from Carlin McCaffrey at Heckerling many, many years ago, but our firm has used it successfully and for clients, and I know other lawyers who've done it as well. And this is what is referred to as a rolling asset splitting GRAT, or rolling sector GRATs, and I'll go through what we're talking about here. So let's back up for a minute, and I know a lot of you know what GRATs are, but I want to go through it slowly to make sure everybody's on the same page. So in a GRAT stands for Grantor Retained Annuity Trust. So you can see on the left-hand side I said Retained Annuity Trust. So the GRAT is a Grantor Retained Annuity Trust, G-R-A-T. So what happens is, in this strategy, the grantor will put assets into a trust and take back typically 2 years of payments. So, and gets interest at the IRS interest rate. It's called this Code Section 7520 rate, and right now that's in around the 2% range. But the interest rate really is not necessarily all that significant when you listen to what I'm about to tell you. So you take back this annuity payment for 2 years. You get roughly half back in the first year, and the other half back in the second year, and a little bit of interest to boot. And so if the present value of these payments you take back is equal to what you put in. So the value of your payments is equal to the value of what you put into this trust. And if the assets grow faster than the payments you get back, then the people who get it at the end, usually your kids or a trust for the kids, they get this big windfall. If the payment back exhausts the trust, maybe the assets have gone down, maybe there's not even enough to pay back the grantor the whole amount. If that happens, the transaction just didn't work. No big deal, because the gift that you declared when you started this trust was a nominal gift. You might have declared a gift of $100 or $1,000, a very nominal gift. This is called the zeroed out GRAT. You don't actually zero it out. You need to have a small gift. But there's no rules on how big that gift can be. So you would do the GRAT, and then if it goes up, then it's a home run potentially. If it goes down, nothing ventured, nothing gained. So now, if you do a diversified portfolio, a lot of people, they have diversified portfolios, and the idea of that is to smooth out your market performance. You want to have it so not so rocky. Well, in a GRAT, you like volatility. If it goes up a lot, you've hit a home run. If it goes down, big deal. You don't get much back, okay? So what we like about the GRAT is the heads I win, tails you lose thing. If it goes up, then more money goes to the kids. If it goes down, it's reduced the grantor's estate. So a GRAT, you like to have volatility. Now, I'm not going to say just so you can have a GRAT, you should go out and invest in risky investments. That would be dumb. But what I do want to say is that normally when you construct a diversified portfolio, you have different assets that move in different directions. You might have basket A, that if that goes up, then basket B might be going down. Basket C might be going sideways. Basket D might be doing something else. So the idea in your diversified portfolio is you're pooling these things that move into different directions, and you're reducing your risk because all of these risks kind of offset each other. Instead of having A, B, C, and D all in one diversified portfolio, you put A into GRAT A, B into GRAT B, C into GRAT C, and D into GRAT D, okay? So if A goes up, wow, you've hit a home run. If B goes down, no big deal. You take back less assets. It's reduced your estate. So another example is let's suppose that you had a 2% payback, okay, is what the goal is. And the assets go up by, say, 5%, okay? So if you just did a diversified portfolio and went by 5%, then you only have a 3% gain. You have the 5% minus the 2% you got back, okay? Now, let's suppose instead that you had two equal baskets. Basket A goes up by 10%, basket B stays flat, okay? So the whole thing has a net overall return of 5%. 10% for one, 0% for the other. You take the average, that's 5%. So overall, if you had them all in one basket, you'd only have that 3% return. The 5% minus the 2%, if only the 3% difference. On the other hand, if you have the 10 and the 0, look what happens. In GRAT A, the 10% return, there's a 2% payback, so there's 8% left over. In basket B, you don't get everything back, no big deal. That's just the way it works. So by splitting it up, you got an 8% return. Okay? If you had them together, you would have had a 3% return. So I'd like to have the 8% return instead of the 3%, and I bet that your clients would like that too. So the idea would be that you would have these, in my example, you might have the loan proceeds go into 4 different LLCs. Each LLC invests in a basket of assets that moves in one particular direction. Okay, and so you can do things with your LLCs, transferring them back and forth. You know, after year 1, half of LLC A goes back to the grantor, half of LLC B goes back to the grantor. You know, you can do that, and the LLC is going back and forth from the GRAT to the grantor. And I wouldn't take discounts on it either. I'd set up the LLC so there's no discounts. We're not going to play discount games here with the GRAT. We want to make things relatively safe. We're going to make it really easy to liquidate the LLCs from a legal viewpoint. We've got the secured accounts, so the lender's still intact. So we're not going to take discounts. We're just using these LLCs as our vehicle to transfer the underlying secured accounts. So no discounts. Just do that and enjoy the fact you're getting your asset splitting GRATs that are having this exceptional return with your deconstructed portfolio. You know, now we're going to go back to the real estate. So to the extent possible, we want to just make the interest payments only because we would like to have the real estate fully leveraged. In the example we had before, we had the $10 million building and a $10 million debt on it. We want to keep that $10 million debt on the building so that it has 0 equity, so that when it's included in the estate for estate tax purposes, there will be 0 estate tax. So take your rental payments on the building and use that to pay the interest on the loan. take the other cash flow and do some more estate planning with it, or use it, or use it for your spending, whatever it is you might need to do with it. But your cash flow from the real estate will be the primary source of the repayments. Now, if your rent is not enough, just think about the fact that we had, these grats, and they were having the LLC interest. If they're going up in value, the lender will let you make some distributions. In fact, I don't think that the lender will make you have the 100% of the account secured. If you have 200% coverage for the loan, so I have a question here. Why would the lender allow the cash in the LLC to be invested in the grats? And the answer is the cash is not invested in the grats. The LLCs are being transferred to the grat. So the cash that's inside the secured account is being invested because we want it to get a nice return. And the lender would certainly be glad for the collateral to be going up. But there is a lot of cushion here because the lender is having 200% collateral, and so the lender can let people have have less than have less than 100% collateralized. They could, for example, like a lot of times a lender will only lend on 50% of the security account. So if the lender loaned on only 50% of the security account, it would still have 150% coverage, 100% from the building and 50% from the securities. So the lender is still very well protected here, and then the lender will also allow you to you can transfer the LLC around, and if there's excess return and you have more than ample collateral, the lender will also let you distribute some cash as well. So if you're going up with these leverage techniques, you can also have excess funds, and then you might have some cash that can be returned to repay the loan too. So what happens if your building goes up in value from $10 million to $15 million? So now all of a sudden you might have estate tax exposure. Well, borrow out another $5 million in that case and put it into another LLC with the secured accounts and continue to do that strategy with this. So what is the result of this strategy? You get a free basis step up. The bank security interest is fully protected because you have 200% collateral, or maybe less, but it's definitely going to be more than sufficiently collateralized. And then your business client is going to be able to say there's not going to be estate tax because you've given away the equity through grats or whatever. If there's not going to be estate tax, you're not going to have that postmortem pressure to pay the taxes. Another thing, for those of you, I know there's some people in financial institutions on the line, so another benefit you have is that you can make money on the loan, and then you can make money by managing the assets under management that are in the secured accounts. So you can get double the money. There was a question here, does the security interest impact the valuation of the LLC? And my answer is that no, it wouldn't, because you're getting a guarantee fee that is the full value of the risk. So here's the other part about this. Each LLC is getting the guarantee fee, so each LLC is automatically getting an extra kick on the return in the investment, okay? The LLC's investments might go up, and the LLC also gets a cash payment in the form of the guarantee fee. So that supercharges the LLC's return. So I thank the questioner because I intended to mention that and I forgot to. So the LLC is going to be successful not only from the investment returns potentially, but also is going to guaranteed get some return from that security, from that guarantee fee. And so the LLC will have full value because it's getting fully compensated for the risk it's taken from the security interest. This is what really got me looking into this, is some comments that were made at some meetings. So let's suppose you have an irrevocable trust and it's got the real estate inside of it, and you're not going to get a basis step up. The grantor might buy back the assets for a note. Now, before we do that, let's think about, is this a grantor trust or a non-grantor trust? You might have been a grantor trust to begin with and then turned off the grantor trust powers. If you buy it back, that would be a taxable sale and there'd be income tax to pay. What you would do instead is the grantor would create an identical trust but have a one that has grantor trust powers in it. So put a little bit of money in, have one that has grantor trust powers in it, like a swap power, and then the trustee would merge the old trust, the non-grantor trust, into the new grantor trust. And because that trust has no liabilities on it, I mean everything got bought free and clear from the grantor, there's not going to be any income tax consequences of converting it to a grantor trust. Then now you have a grantor trust, and so the grantor is going to buy it back. Now, if the grantor buys the assets back in exchange for a promissory note, there would be no income tax on the consequence. So far, so good. When the grantor dies, now you have this note that the trust holds. Now remember, for income tax purposes, the note did not exist before the grantor died. Okay, that's our sale to the irrevocable grantor trust. Revenue ruling 8513, 85-13, says that you disregard the transaction for income tax purposes. So, but this note also was disregarded until the grantor died. Now, all of a sudden, there's this note inside this irrevocable grantor trust, or it's not a grantor trust anymore. On death, it's a non-grantor trust. What is the basis in that note? I always kind of assumed it would be the value, but I don't know that I can prove that. And so I don't have anybody who's been able to tell me for sure, here's the legal basis for that. There are no cases on it. So you're taking a risk that there might not be basis in that note. And then when you pay back the note, there's going to be income tax. So the better thing to do would be to borrow the money from the bank, and when the grantor dies, and then you go through this whole thing that we just went through here, use the same type of scenario. So question, is the guarantee fee taxable ordinary income to the LLC? And the answer is no. During the grantor's life, what I'm positing is that these LLCs are going to be transferred to grantor trusts. So the LLC is owned by grantor trusts. Now, the LLC might be owned part by the grantor and part by grantor trusts, but there's a revenue ruling that says that when the grantor and grantor trust all own an LLC, the whole thing is considered a disregarded entity for income tax purposes. So you could have 3 or 4 grantor trusts owning the LLC along with the grantor, and it's all deemed owned by the grantor. The LLC is a disregarded entity. And so when you pay the grantor the guarantee fee to the LLC, that's a disregarded transaction. There's no income tax consequences. Now, if you do wind up having something where there's a guarantee fee and you have a non-grantor trust, then you might be generating some ordinary income to the trust, and the grantor might not be able to deduct that. So you might need to do something else at that point. Code word, which is up. That's because we're looking for ways to get a free basis step up and hopefully you've benefited from this to understand that. Oh, I have a question. Type of trust in a GRAT, is there an ETIP? And the answer is yes, GRATs do have technical issues, and that's beyond the scope of this. I'm happy to discuss that with people later on. You can email me or call me. I'm going to talk about something that has a really scary sounding name. At least it was scary sounding to me. But I read this case, and they had a really cool application, and so I took some time to learn it, so now I'm going to share that with you. There was this company that went public, Monster.com. You might have heard of this. And the owner of Monster.com engaged in a clever strategy. A lot of taxpayers have done this strategy before and they got it wrong, but this guy got it right. So here's what he did. He borrowed money from a bank. Actually, he had two different banks involved, and he said to the bank, I'm going to pledge my stock to you in exchange for this money. And I agree that at the end of a particular period of time, I am going to pay you back that money. And I might pay you back with the stock. I might pay you back with cash. Who knows? Now, if I don't pay you back, you can take back the stock because you need to be secured in your loan. But you really don't have any right to get paid in the stock. I can pay you back cash if I want to. So that is what's called an open transaction because we don't know what the loaner is going to get paid back with. And Revenue Ruling 2003-7 approved the open transaction treatment. And they said that, that until this thing is settled, that there's no gain on the sale. So there's no gain unless you settle the contract using non-cash assets. Now, another key point, now the case that I'm going to tell you about in a minute didn't address the second bullet point, but this follows necessarily from it. Normally, if you sell an asset in exchange for an installment note, that gain gets locked in. You have to pay tax on that gain. And when you die, because you have a locked-in gain, that's called income in respect of a decedent. And you don't get a basis step-up, okay? So if you have property with a zero basis, you sell it for $1 million. You have a $1 million note that's included in your estate. The $1 million note still has a zero basis because you never recognize the gain on that. The $1 million, we know that the property is sold for $1 million. There's no doubt about it. So that gain is locked in. The concept of income in respect of a decedent is, do we know that the gain is locked in? Do we know the income is locked in? Okay. If it's locked in, then it's income in respect of a decedent, and you don't get a basis step-up. So an installment note does not get a basis step-up at death. In this case, though, this is an open transaction. We have not sold the securities, okay? He didn't sell the securities. He promised to pay the money back, and he didn't, in cash or in securities, at his choice. There was no assurance that securities would be sold. He could have come up with that money some other way. Or he could sell the securities to somebody else and pay off the lender with cash. Okay? He had all kinds of options. It was not locked in that there was going to be a sale at the end of this. So because if it's an open transaction, it is not IRD, and there is a basis step-up. And my materials provide all the authority for this. And this gives you the name of the tax court case, Estate of McKelvey versus Commissioner. And in this case, So on date A, the decedent borrowed the money and said, okay, bank, I'm going to pay you on date B for pay you that money back. It's kind of like, you know, Popeye the Sailor Man. So Wimpy says, I'll pay you Tuesday if you give me the money for the hamburger now. So same thing. So date B is about to come along. So we're coming up. It's Monday night, and Wimpy owes his hamburger on his payment for the hamburger on Tuesday. So Wimpy is like, you know what? I don't want to pay you yet for the hamburger. Instead of paying you this Tuesday, can I pay you next Sunday? And that's what Mr. McKelvey did here. He said, I don't want to pay you yet. Let me pay you later. Let me pay you on date C. And the bank said, okay, if you pay me some additional money, I'll extend the payment date. And of course, that gives the bank, you know, interest on the loan essentially, and maybe a little bit extra profit to boot. So the IRS said, wait. Date B came along. You had pledged assets, that note was due. You had income then. So the taxpayer says, well, wait a minute. I didn't get anything. I didn't get paid for the securities. I paid the bank. They didn't pay me. I paid the bank. That was money going out, not coming in. I didn't sell these securities. And the tax court said, you're right. You did the transaction the correct way. Now, I don't know what Mr. McKelvey's estate planning actually was, but let me just tie this in to what we've kind of been talking about before and see whether you might be able to do something like that. Okay, so what if Mr. McKelvey had previously done a sale to an irrevocable grantor trust, and he wanted to buy those assets outside of the trust? He could have used the scenario that I ran through earlier. Or what if he might have taken these loan proceeds and bought securities from the irrevocable grantor trust? Okay, so the irrevocable grantor trust had that cash. Okay, so he had the note. He had the securities from the irrevocable trust are now included in his estate. He has a loan to offset that obligation. Okay, so he gets a basis step up on the securities he might have bought from the grantor trust, and he gets a basis step up on the securities that he pledged for the loan. So he might get a basis step up for both of those, and then holds them, gets a basis step up, sells them, and then satisfies the loan. And now he's managed to get the basis step up from what was inside the trust, and the trust has cold hard cash that it got to invest in it, so it has 100% basis too. So maybe we can combine those things. So I thought Mr. McKelvey was his planners did a great job on it, and he told you how to use the revenue ruling, so you might want to use that in your practice. There was a horrible case that just came out. I didn't really analyze the case in my newsletter, but it's the estate of Powell versus Commissioner. And what happened is that they formed their family limited partnership, and the tax court didn't buy it and said, include it in your estate by Code Section 2036. And so then here's a question. Let's suppose you have a partnership, and you have a partnership interest that's included in your estate. Okay, normally that partnership interest, you're going to get your new basis, perhaps a basis step up, but you don't get an inside basis, a basis in the partnership's assets itself, unless you have what's called a 754 election in place. The difference is that if this partnership interest is included in your estate, and I'm sorry, if the partnership interest is disregarded for estate tax purposes. So the tax court is saying, hey, the partnership interest was included in your estate, it was the assets themselves. Or maybe in the Powell case it was both, which was really potentially awful. But the assets inside the partnership are included in your estate under Code Section 2036. You get a basis step up in those assets, a direct basis step up. And there's, my materials do have a reference to some private letter ruling that stated that, but there's also another tax court case on slide 19 that discusses that. And this is Hereford Investments versus Commissioner. And this case, the name might sound familiar to those of you who like to follow family limited partnership cases. In the Hereford case, the first decedent died, and then assets got included in the estate, and the partnership was looked through, and so there was a reported case on that. And then the surviving spouse had that, and it was in a partnership, and then the surviving spouse had put this an IRD asset to the partnership. It was like some kind of stock option. I don't remember what it was, restricted stock or stock option or something. It was deferred compensation. But the surviving spouse put it in the partnership, and there should have been an income tax recognized at that point, but they didn't report it. They didn't think about reporting it. And what the Hereford case, and this case is in the tax court docket. There's no tax court memo number or anything like that assigned to it. You just have to actually look on the tax court's webpage to get the docket. And what happened is that later on the partnership wound up selling that asset. The partnership was included in the estate when the first partner died. According to prior court action, the court held that the partner's estate received an automatic basis step up on the partnership assets. Didn't have to do a 754 election. They were directly included in the estate, and there was a basis step up in it. Because the IRD was supposed to have been triggered when it got transferred to the partnership, in the partnership's hands, that was no longer an IRD asset. The IRD was supposed to have been triggered. It became a capital asset. And so what happened is that when the partnership sold that IRD asset, it got capital gain treatment under the special code section 1234 capital A. That a lot of people, most estate planners don't know what 2034 capital A is. But 2034 capital A basically says that if you have a contract right that relates to a capital asset, then that contract right can get capital gain treatment. And the court held that 1234 capital A provided long-term capital gain treatment. So what you really should consider doing here is, if you have an IRD asset, if you think that IRD asset is going to go up in value, and that you might hold on to it and get a basis step up, or just if the IRD asset might just increase in value in the future, take your lump sum now. Do a transfer to a partnership, trigger that IRD at the smaller value now. Then later on, when you sell it for 10 times the price, you'll get capital gain treatment. So any of your IRD assets, consider doing something that triggers IRD now if you think it's going to go up a lot in the future. We took the limit of an IRD asset, the limit of estate tax inclusion, and we turned it into a basis step-up, we turned it into capital gain treatment, and we got our lemonade. So that is our last code word. My next webinar is October 31st. The slides that were originally posted to the webpage said the 24th. That was a typo. I apologize for that. The 31st is the next webinar for my third quarter newsletter. I encourage you to sign up for my blog. There's also some heckling reports that are going to come out. They come out every January. I encourage you to sign up for those. And now that we're done, I encourage you to please fill out your evaluation form and follow through with everything. Get your COE credit. I hope that you subscribe to my newsletter if you haven't yet. I certainly welcome anybody to call me with questions, and I look forward to further contact you with you in the future. Thank you very much for attending.